Hello everyone. Today we are going to discuss and get into the deep analysis of HDFC Bank and South Indian Bank. So as you know, these two stocks are these days kind of hot stocks, wherein the HDFC Bank has been falling continuously for last 2-3 trading sessions, and South Indian Bank has been rising up from its low level up to its 52-week high as I speak. As you already know, we had discussed in detail about all the parameters which shall be considered while analyzing a banking stock, which includes the deposit growth, the advance growth, loan book growth, investment book, cost to income ratio, net interest income, net interest margin, PAT, capital adequacy ratio, asset quality, which includes the gross NPA and the net NPA, provision coverage ratio, provisions, CASA ratio, the credit to deposit ratio, cost of liabilities, segmental revenue, retail versus wholesale business mix, the geographical mix, the competition from PSUs, the valuation matrices like the ROA, ROE, ROCE, price to book, then the peer comparisons, the monetary policy, the impact of regulators bringing in various policies, macroeconomical factors impacting the banking stock. So all these things we had very well detailed out in our session number 97, which was the last session, all about how to analyze a banking stock. So if you have not seen that video, I kindly request you to go back, uh, put in your time to go through the entire video, and once you are done with that, then as I had promised in that video, we are going to analyze uh, a set of banks including the HDFC and South Indian Bank. So almost 6-7 banks we are analyzing in this session. I have tabulated all the parameters like in the way of a comparison, wherein we'll be looking through all these parameters which we have discussed for all these banks, the major banks including the HDFC, ICICI, Axis, Kotak Mahindra, IDFC First, Federal Bank and South Indian Bank. So these factors we'll be analyzing for each of them, and we will understand about their valuation, their revenue model, their profitability, their shortcomings, and whether we should be thinking of getting into any of these stocks. This is never a stock recommendation, but I'll be helping you to understand and analyze these banking stocks, and based on your due diligence, you can take the call. So let's directly get into this. So on the screen, if you can see HDFC Bank. So HDFC Bank shares falls for the third day in a row. As I told, stock falls over 12%. So this is all been over the news. So if you see on a 3-year basis, the CAGR, the yearly return which the bank has given, HDFC Bank has given, is just 0.1%. So not even FD return, far it's like zero return, I can say. And if you see on a 1-year basis, it is in fact minus 11.5 CAGR. So this shows that how the HDFC Bank has hugely underperformed. So this is not like you should sell HDFC Bank or something. So we'll get into that in detail in the session. And if you see again, as I told, HDFC Bank, the 1-month return minus, 3-month return minus, 1 year, 3-year, all are minus, and 5 years also it is just 7% odd percent, and also 10 years you can say it is 16%. So why on a longer basis it is having a higher return compared to shorter duration? All these things we'll be discussing. So this is a snippet from the value research site. So again, if you see South Indian Bank, the South Indian Bank uh, completely reverse to what has happened to HDFC Bank. It has soared almost 3% on one day, so Thursday. If you see literally every day since a few months now, it is rallying every day, uh, even more than 10% a day, so something like that. So if you see on a 1-year basis, the CAGR is 70%, and for 3-year basis, it is like 50%. So clearly, it has been an uptrend for South Indian Bank because now the Q3 results are also out, and as you see on the screen, the profit has raised almost 200%. So things has been like this with South Indian Bank. So not to worry, again we will be discussing this in the session. Now let's get directly into the figures. So here if you see a very clear tabulation of various things which we have discussed in the last video is tabulated here. So I have put many efforts in compiling this data. So on the screen you can see total income revenue. So again on the second screen you can see the financial evaluation. So this was the business overview, the financial evaluation, then the health checkup, including the NPAs. So then the valuation ratios. So all these things has been duly compiled and presented to you for your clear understanding about the banking stocks. So here you can see HDFC Bank, and here you can see South Indian Bank. So my analysis is more on HDFC and South Indian Bank, and obviously you will get to know about other banks also, like ICICI, Axis, Kotak, IDFC First, and Federal Bank, because these are all kind of greatly discussed banking stock these days. So another disclosure here is that I am holding HDFC Bank, which I have recently entered, like 1 year back. I had entered in HDFC Bank, and also I have been averaging the position in HDFC Bank during this recent fall as well, and I hold sizable portion in HDFC Bank, which is obviously for a long-term investing point of view. And also South Indian Bank, I am invested since, I can say, more than 10 years. And also this has been some stock which I have been invested since its IPO. So in fact, this is some stock, South Indian Bank, wherein the IPO, while the IPO was there, the physical stocks, the share certificates, at that time there was no demat account, so the share certificates was given to my dad. So he had, in fact, at that time, years back, once the IPO had released for South Indian Bank, which is basically a company or a bank from Kerala, based in Kerala. So he had bought 100 shares of this at its face value, like for 1 rupee, so 100 shares. And while he was handing it over to me after a period of more than 10 years, 10, 15 years, it was around 1,870 shares multiplied over a period of time with stock split and other things. And the valuations or the price of that South Indian Bank was something around 36 or 40 rupees, 36 to 42 rupees, as I remember. So that is how the compounding works. So he had not been a active investor, or he doesn't invest in stocks, but he had bought IPO at that time, and that was the only stock which he had invested in. And if you see the multiplication or the uh, compounding of the stock which has happened, it is enormous. So that is the impact of holding long, which is to be considered while investing into stocks. Now getting back to the topic, so South Indian Bank is another stock which I am holding. So over the period, I have bought a number of shares in South Indian Bank, and I hold a huge position in South Indian Bank as well in my stock portfolio since years, which has given me good returns over the period. Now, total income. So that's the revenue of the company. So before that, you know that HDFC Bank has recently merged. So HDFC and HDFC AMCs has, so HDFC Bank and HDFC Limited has merged uh, 2 quarters before. And if you see the results post merger, so that is been mentioned here. So if you see, HDFC Bank is a bank, and HDFC Limited was a NBFC, wherein they didn't have any deposits. Now before getting into the analysis, you see, like HDFC Bank, it has been 2 quarters that it has merged. That is the HDFC Bank and the HDFC Limited. The HDFC Limited was an NBFC, and HDFC Bank obviously was a bank. So if you see, the cost of borrowing for the NBFC is higher, because either they raise funds from banks, like almost 30-35% of their borrowings comes from banks. Like banks already have a deposit, and they lend almost 30-35% of their deposits at a particular interest rate to the NBFC, and NBFCs in fact lends at a higher rate to the borrowers, wherein that delta is their profit. So unlike a bank, they don't have any reserve bank liquidity requirements like the SLR or CRR ratios, which already we have discussed in the last session 97. So so that's all about NBFC. So the cost of lending is high, but after the merger, the HDFC, the complete loan book will be transferred into HDFC Bank, which we can see in the analysis also. But also their borrowings are also higher compared to a bank, because as I told, they don't have any, they cannot actually take any deposits. Like the CASA ratio is not available in a NBFC, so they don't have any current account deposits or savings account deposits like that. So they have to either get lend it from banks, like 30-35% as I told, or else they have to raise bonds. Uh, so corporate FD, or they have to raise bonds, and based on that they will set a coupon rate, and they will raise the fund, and that fund will be given out as a loan to the borrowers. So that's how an NBFC runs. But NBFC, as in comparison to a bank, has got simpler processing of loans, no much stringent requirements or background checks. So that's why many people go ahead with NBFC, because their eligibility criteria is very less, unlike a bank. So you have a loan, you have a huge loan book or advances for NBFC. So this entire thing has been shifted to the HDFC Bank while they have merged, but they don't have a deposit. So that is why in the deposits, you can see that there is no much increase in the deposits overall, but the loan book or the advances has increased a lot because of this thing. So that we will see in the coming slide. So that's about the merger. So HDFC Bank, if you see the total income post merger is around 3,40,000 crore, and before the merger it was only 2.1 or 2 lakh crore. So if you see, still HDFC is having the largest total income or revenue in that case, after which comes the ICICI Bank, and then the Axis Bank, and the Kotak Bank. So South Indian Bank is a small cap stock, but still it has got 8,000 crore total income, which is sizable. Now getting back to HDFC Bank, the revenue growth has been, see, if you see, it is 58%, because post merger the revenue is a combination of the HDFC Bank and the HDFC Limited NBFC, which is no more different now. It's the same HDFC Bank. So the same, that 3.4 lakh crore and 2.1 lakh crore is interpreted here as 58% and 25%. The borrowings, as I told, NBFCs doesn't have any CASA deposits, so their borrowings is high. So if you see, before merger, the HDFC Bank was only having 2.5 lakh crore uh, uh, borrowings, but post merger, see, it's a whopping 8 lakh crore uh, borrowing. Borrowing has tremendously increased, which has been one major concern for the investors. And also, if you see the PAT, the profit after tax, is around 60,000 crore for HDFC Bank. Why I have not mentioned both post and pre-merger is because only for those items for which that merger has been important, those figures only I have mentioned separately. Otherwise, PAT, there has been no much change. So that is why I have not mentioned the different two figures. Now, net profit margin also, if you see on uh, trailing 12-month basis, which is TTM, is 36.55% post merger, which is after the merger, and before merger it was only 21%. So the profit growth also have increased tremendously after the merger, I can say, because both the entities has become one. And if you see, in case of Axis Bank, it is negative, and in case of South Indian Bank, you can see it has increased a whopping 56%. So IDFC Bank also has increased, the net profit has increased tremendously, because in IDFC Bank they have been offering uh, good interest rate on the savings account and the fixed deposits. So that is why they have been able to attract new depositors, and these deposits has been utilized for lending, and hence creating higher profit margin, you can say. So the net profit margin uh, is around 27% for HDFC Bank, obviously it is post merger, and in case of South Indian Bank, it is slightly less, it is around 11%. But they, we can see they are improvising, or they are improving the net profit growth. So as the profit growth increases, even though the profit margin is slightly less, so it can compensate for the total profitability of the company. So if you see the PAT, it is around 1,000 crore for South Indian Bank. Axis Bank, the PAT is very less, and the net profit growth is also in negative, and net profit margin is also very less, which is just 12%. So IDFC Bank also, the net profit margin is less. So what IDFC Bank is doing, they are giving out a higher interest rate on their CASA, or in their savings account, or on the fixed deposit. So they have been able to increase the CASA ratio, but their interest spend on the deposits is much higher. So even though they were able to increase the volume, means the deposits increase in depositors because of the attractive interest rates, the uh, profit margin has been diminishing or decreasing, because of the higher deposit rate, interest rate which is paid out on the deposits. So the total income we saw, revenue growth, borrowings. So borrowings has been a concern for HDFC Bank because of that, as I told, the NBFC merger. Then the profit margin we saw, South Indian Bank is really attractive. The profit growth is really attractive, and also Kotak Bank, if you see the net profit margin has been on a higher side, which is 35%, and equally HDFC Bank is comparable, which is 27%, which is a decent figure. Similar for ICICI Bank also, the figure is somewhat near to HDFC Bank only, 28, 27, 36, 34. So it's very much comparable. Now getting to the financial evaluation. Now if you see the HDFC Bank market capitalization, you can see, and all the banking stocks market capital you can see here. The dividend yield is the highest for HDFC Bank, which is 1.29, and the deposit growth, if you see, post merger, like after the merger it is 21%, and before merger it has been 17.5%. So deposit growth has only slightly increased after the merger, because as I told, there is no much deposits in the NBFC. Their funding for the lending is purely through bonds and borrowings from the banks or investors. The deposits has been 22 lakh crore, around 22 lakh crore has been the deposits for HDFC Bank, and the advance growth, if you see post merger, it is whopping 51%. So that's why I told the NBFC has got a big loan book, and the advances from this, that is the loans from this NBFC, has been merged to HDFC Bank. So HDFC Limited loan book is merged to that, which has increased the advance growth by 51% compared to just 17% loan book growth, considering only the HDFC Bank before the merger. And similarly, IDFC Bank also, you can see the loan book has increased because they are able to lend it at a attractive interest rate, and also they are able to get enough deposits by offering higher deposit interest rate as well. So that is why they are able to increase the uh, advance or loan growth. So deposit growth also, if you see IDFC Bank 37%, which is obviously because they are offering highest interest rate. So that's the strategy. So it's fast growing as well. Profitability. വേണ്ട കമ്പനി വന്ന് profitability എന്നുള്ളത് പറയണ്ട. Okay. Now getting into the advances, again advances, the loan in crores which is mentioned. So loan is around 16 lakhs before merger, and after merger it has become 25 lakh crore. So that's a huge jump because of the NBFC thing pitching in. Now if you see, South Indian Bank has got an advance or the loan growth of 16.35%, which is the lowest in the category. But still, if you see the advances or the loan book for South Indian Bank is 7,76,000, which is also a decent figure considering its small or the size of the bank. And investments also, South Indian Bank has got 25,000 crore, and HDFC Bank has got investments of around 9 lakh 62,000 compared to just 5 lakh 10,000 crore or 11,000 crore before the merger. So investment also has increased substantially for HDFC Bank, because as I told, for NBFCs the investments are much more compared to a banking stock, because their profitability comes from larger investments and also by lending at a higher interest rate to the various borrowers. Now getting to the cash and balance with RBI, which includes the various SLR and CRR deposits as well. So that is something around 1 lakh 28,000, like after merger, and before merger it has been somewhat around 1 lakh 20,000 or 1 lakh 17,000. So no much change in that. Now coming to the cost to income ratio. So cost to income ratio has been almost similar post merger and before merger, no much change. And if you see for HDFC Bank obviously, and for IDFC First Bank, the cost to income ratio is very high, and out of the category the highest is for the IDFC First Bank, which is 70.79%. So if you see, as I mentioned, as I mentioned in my earlier session, the cost to income ratio, the lower, the better. So actually, it measures how efficiently a bank manages its cost relative to its income. So if the cost to income ratio is high, then which means that the bank's operating expenses is very high compared to the operating income. So obviously, IDFC First Bank is a fast growing bank, so their cost is comparatively higher because they are spending a lot on the marketing activities and for growing the bank exponentially. So hence, compared to a stable bank like HDFC Bank, wherein the ratio is just 40%, and even South Indian Bank is also aggressively digitalizing their platforms and also marketing their products. So there also the percentage is slightly higher, which is 62%. But going forward, this is all supposed to come down as the bank takes a grip in the market. Now getting into the net interest income. So net interest income is around 1,18,000 for HDFC Bank, and for South Indian Bank it is around 3,300 crore, which is also a fairly good thing. So the net interest margin, if you see, it is 3.28% for South Indian Bank, and for HDFC Bank, after merger it has come down to 3.67. This has been a major concern for the market to again punish the HDFC stock, because if you see, before merger this has been slightly higher, which is 3.92. So net interest margin, as you already know, it's a spread. So total deposits are not lent out, some kept for safety and some kept with RBI, rest lend out. So net interest margin is the difference between earned margin on lend out amount minus the interest paid on deposits received. So if you get a higher interest rate and a lower interest paid out for deposits, then the spread increases and hence the net interest margin increases, which will directly impact the or directly contribute to the PAT or the profitability of the company. So higher the figure, the best it is. If you see, the figure is highest for IDFC First Bank. So they have been, it has been a lower value in last quarters, but this time they have been able to uh, achieve a higher net interest margin so that their profitability is increased. And also, if you see, HDFC Bank is having a net interest margin, as I told, 3.67% compared to before merger value of 3.92 for the HDFC Bank. And South Indian Bank is also around 3.28% considering the size of the firm, and also the NIM has been constantly increasing for the South Indian Bank, which we'll further decode in the coming slides. And coming to, but if you see, this is one of the major figure for analyzing the profitability of a banking stock. So it should be higher. And the CASA ratio, if you see here, HDFC Bank after merger it has been 37.6. So this has reduced because, as I told, there is no deposits from the NBFC HDFC Limited thing. So the only deposit which is CASA deposit which is available is with the HDFC Bank. So the CASA ratio has substantially reduced because CASA ratio, as you know, it's a ratio of the deposits in current and savings accounts to the total deposits. So that ratio has reduced. Before the merger, it has been 44.39, which was a decent figure, because figures above 40% is normally considered healthy as far as a CASA ratio is concerned. Here, if you see, it is 37.6%. Also, if you see, South Indian Bank is also got a lower CASA ratio of 31.8, and they are struggling to increase the CASA ratio so that you have lesser interest paid out on the deposits and they get more funds, so that they can utilize that for lending and get higher interest income, and hence increasing the net interest margin, and hence increasing the profitability or hence the PAT of the bank. So IDFC First again has been having a good CASA ratio of 50% because of their consistent struggle for getting the market share and also their business strategies. Now getting into the health checkup. So again, HDFC Bank, the capital adequacy ratio, the higher implies advance growth rate can be rapid or high. Capital to give out loan can also be high in that case, and also the lower NPA and higher CASA and a lower cost of liability, which implies a higher advance or loans, which implies or which results in higher ROA, ROE, and EPS. So that's how the complete business of banking works. So HDFC Bank, after merger, the capital adequacy ratio has been reduced to 18.4%, almost 1%. There is a drop because we're in before merger it has been at 19.26%. So the capital adequacy ratio for Federal Bank also is very low, 14.81. South Indian Bank is 15.6. Again, it's in a uptrend, so they are struggling to improve the capital adequacy ratio by getting in more CASA and deposits. So Kotak Bank also has got a good 20.78% capital adequacy ratio. Now getting to net NPA, net NPA is lowest for HDFC Bank even after the merger, and South Indian Bank it is the highest, which is 1.61%. Now gross NPA it's 1.12, the lowest for HDFC, and the highest for South Indian Bank, which is at 4.74%. So clearly NPA is on a higher side for South Indian Bank. Hopefully they are working on that. And HDFC Bank it is on a very low side. But if you see the provisions and contingencies for the post the merger, the value has been 14,000 crore for HDFC Bank uh, compared to the earlier around 11,000 or 12,000 crore. So there has been almost 2,000 crore plus provisions or contingencies been added. This is because as per RBI rule, the latest RBI rule, for any alternate investment funds, which is called AIF. So for holding any AIF funds, either they have to liquidate it, and if they are unable to liquidate it, then they have to consider 100% provisioning against that complete amount. So that is why HDFC Bank, based on the alternate investments which is held by NBFC stocks before merger and after merger, it has been transferred to the HDFC Bank. So for equivalent amount, they had to have the provisioning. So this is not for NPA provisioning, but it is for AIF provisioning. But still, that amount has been put here, and whatever provision has increased, so that much amount will not be available for giving out for lending or loan, because it is becoming the part of provisioning. So this also impacts the profitability of the HDFC Bank. So that is another concern which the market is having, again leading to a higher selling in the past few days. Now the PCR ratio, also provision coverage ratio, tells if the bank is vulnerable to NPAs or not. A PCR ratio of 70 plus is considered healthy for the banks. So all the banks are having a higher ratio, but even if you see if it is extraordinarily high, so it implies that the bank is anticipating a higher NPA, and so the provision coverage ratio also has to be kept on a higher figure. So even the bank is IDFC Bank is IDFC First Bank is small. They are having a higher provision of around 1,600 crore. So they are having a higher provision coverage ratio also, 83%. So 75% is fairly considered to be a good value. Not a even very high value is also not considered good. Now the loan to deposit ratio, if you see, uh, as I told, as the NBFC has brought in lot of loans, the advance, but without any deposits, the ratio, the numerator has increased a lot in loans, but the deposit has not increased. So that is why there is no deposits to service the loans. So in fact, the figure has gone above 100 for HDFC Bank after the merger. So that is why it has become very uh, alarming for the investors also, because if they don't have any deposits to give out the loans, then they will have to borrow the money at a higher rate and lend it out. So this will lead to eroding their profit margin, the net interest margin. We can see that it has eroded, for, and going forward, it may further erode before it stabilizes. So because of this, the profitability of the bank has been impacted. So this is one of the major reason the bank profit dipped, and because of which there was a major sell-off in the bank. But if you see here, the South Indian Bank is having a right mix of around 78.25%, which is lowest in the category. So loans to deposits, so deposits are adequate enough to service the loans. So this is a good figure for South Indian Bank, which is highly positive. The IDFC First also is having good amount of loan and deposits are less, this is also alarming, because again this is above 100%. Now the cost of liabilities, cost of funds to the deposits is the cost of liabilities. The cost of funds is nothing but the interest rate which is paid out on the deposits. So if that value is high, so that means that the CASA mix is not good, the current account is maybe lesser and the savings account or FDs are more. So the interest spent by the for the deposits by the bank is higher, so compared to the total deposits. So this is actually a issue. Now if you see post merger, uh, means the after the merger, the HDFC Bank is having a higher cost of liabilities. The interest rate paid out is higher. So this is also alarming. Also IDFC First is also having a higher percentage. The rest all banks are having a lower figure, the lowest being Kotak Mahindra Bank. South Indian Bank is having slightly higher 4.28, but hopefully these banks bring it down, so that the uh, cost of liabilities, the lower is better, so that they can generate more profit. Now coming into valuation ratios, HDFC Bank is currently at a good valuation, around 2.66 price to book after the merger, and price to earnings also it is 18.91, because the bank price has dipped around, it is currently at 1480 rupees, uh, all the way down from their all-time high, and ICICI Bank is having a higher price to book value. South Indian Bank is having a good valuation, very good valuation, which is at 0.87, and the price to earnings is also at 5.77, which is extremely good value pick, I would say. And HDFC Bank also being bigger, price to book also has dipped, and price to earnings, though it is at a higher level, but still it's at a good figure compared to its peers, wherein Axis Bank is having 26, Kotak Mahindra 20, IDFC First 21. So it's at a good valuation. PEG is also at 0.9. Anything below 1 is considered as fairly valued or undervalued, you can say. So ICC South Indian Bank is at slightly higher valuation, 1.77. Now the ROA minimum of 1% is expected. Here South Indian Bank is having 0.91, again a concern over here. And HDFC Bank, if you see, it is at 3.09%. So that is the highest. So that's at good return on assets, you can say. And ROE is also at 15.94 for HDFC, which is good. Axis Bank is having the highest ROE, 25%, and South Indian Bank is also having 14, good one. ROCE for HDFC Bank 16%, and ROCE 14%, again a good value. EV to EBITDA ratio is very low at 13.18% here, but in case of HDFC Bank, it is at a very high value. So enterprise value to the EBITDA value, because the EBITDA has dropped a lot, so that is why the figure has become very high. So this is kind of showing that it is highly overpriced. But considering the other valuation matrices like the price to book and price to earnings, it is at a fairly good valuation. So from here, I don't know, the price may dip little bit as well, but this can be considered as a good time for investing in HDFC Bank for averaging the price. Now, coming to the HDFC Bank performance evaluation, if you see, as I told, deposits has been slightly increased post the merger from March 23 to the currently as I speak, January 2024. Means this is inclusive of the December 2023 quarterly results. And borrowing, if you see, it has been highly increased, because after the NBFC coming in, around 8 lakh crore has been the borrowings, compared to just 2.56 lakh before the merger. And also, if you see here, as I told, during the quarter ended 31, the bank has a contingent provision of 1200 crore in respect to investments in alternate investment funds pursuant to RBI's regulation after. So this is one of the note in the quarterly results, because this is like the provisions they have to consider for the AIFs which they are having. So also these are the some subsidiaries, the complete subsidiaries or direct or indirect subsidiaries of the company. So this is what the HDFC Bank is made up of. Just you can go through this. Now the total provisions also, if you see, in 2007-2023, it has increased like 1.1200 crore has increased quarter on quarter. This is just for the AIF, as I told. So this is the circular from RBI on the alternate investments. So I have highlighted those lines. If an AIF scheme in which RE is already an investor, RE is like regulated entities, which is like a bank, and makes a downstream investment in any such debtor company, then the RE shall liquidate its investment in the scheme within 30 days from the date of such downstream investment by AIF. And in case RE are not able, like the bank is not able to liquidate their investments within the above prescribed time limit of say 30 days, which is 1 month, they shall make 100% provision on such investment. So that is why HDFC Bank has to do that provisioning, extra provisioning, and that provision is not to be interpreted as NPA provisioning, but this is for the AIF provisioning. But end of the day, that money has been lost, which could have been lended and made some decent profits. So that is why the margins of the bank has been impacted. Now, some glimpses of the HDFC Bank growth in advances and deposits. So this has been the growth over the years or the quarters, and deposits also has increased, which is slight quarter on quarter. It has increased by 2%. The growth across all segments, retail, wholesale mix, everything which is given here, retail mix is 55 and the wholesale mix is 45%. So the wholesale retail composition is given here. Stable and granular deposits. So as I told, granular deposits are very important, so that the NPAs are very much reduced. So the retail is around 83%, which is very good, and wholesale is like the corporate lending is just 17, and currently speaking is just 16%. So CASA deposits, if you see, current account is around, you can say 25%, and rest is savings account. So CASA ratio has slightly dipped to 38% here. So that's because the savings account has increased, though the current account has almost been the same. So that's why we are having a lower CASA ratio, which is actually a concern for the impacting the margins of the company or the bank. Now the branch network details are given here. Customer base also is given here. Capital adequacy ratio has decreased, as I told in the earlier slide, which is a concern. Net interest income has grown year on year, quarter on quarter. Net interest margin has dipped actually to 3.6, 3.67 levels, which we have mentioned earlier, which is again a concern. And bank will have to get more deposits and increase the CASA ratio and improve the net interest margins, so that the companies or the bank's profitability gets back and the stock price also follows the earnings of the bank. This is again the corporate rating mix of externally rated wholesale books, corporate and mid corporate. So almost 75% is AAA rated or AA rated or AA and above rated, I can say. Shareholding pattern, as I told, FII, FPI is around 45%, 46%. The rest is by mutual funds, ADR, and individuals. Consolidated income statement also it is shown here. Now getting into South Indian Bank investor presentation. So again, you can browse through this, the how the diversified loan book with granularity and growth has increased quarter on quarter. So you can have a analysis on all these charts, wherein you will get a clear understanding of what the bank is intending to grow going ahead, and increasing share of A rated corporate loans you can see here. So how it has increased over a period. It's all self-explanatory. So diversification also, if you see, in Kerala almost 40% is there, and now the network is expanding to rest of India. You can see over here as well the number of branches shown, almost everywhere it is there. You can see gradually it is expanding its customer base. ATMs also, branches also, customers also has increased year on year. Net NPA, it is at a higher level, but still compared to its previous levels it has reduced a lot. You can see from 6.97 it has fallen to 4.74, which is a good improvement. Again, for net and gross NPAs, it has fallen. It's a good sign. Now focus on recoveries and upgrades. Significant improvement in PCR ratio you can see. Collection efficiency also has improved over a period. So high digital transaction also has increased the revenue of the company or of the bank. So mobile transaction, internet transaction, you can see here rather than the offline transactions. So way forward, what is the strategy? These are the strategies which is listed by the South Indian Bank. So you can see, you can read, and it is all self-explanatory how they are boosting up their investor confidence by these announcements which they are incorporating year on year, and their profitability or their ratios, the improvisation in their ratios is also evident from these strategies which they are incorporating. 5 areas of focus, they have mentioned all these 5 things. You can pause the video and go through this. Also enhancing portfolio resilience. So these are all the things which they are concentrating on, including the renew growth of MSME business. So retail business also, rightful share of retail businesses. So more the retail businesses, it is granular in nature, and the chances of big corporate failing and having a big NPA is avoided there. Again, lesser NPA means lesser provisioning, and that amount can be utilized for giving out granular loans, and hence increasing the profit of the bank. Improving branch productivity, what all things they are incorporating, this is mentioned here. Again, pause it and go through this. Cost optimization, what all things they are incorporating, again it is shown here, please go through this. Now the capital composition they have given. So again, self-explanatory. Tier 1 and Tier 2 mix they have given here. So this is all about the analysis of HDFC and South Indian Bank. So I'm sure that the valuation wise, South Indian Bank is at a good point. We can see the business is developing, improving. All the figures, ratios are improving quarter on quarter and year on year. So South Indian Bank can be a good turnaround story. And HDFC Bank, now the bank has been beaten down. The almost 13 to 15% drop has happened last in the stock price, and also last 3 years it has been a flat return or zero return, I can say. So uh, the investors are very much in a panic mode of selling it off. So like Warren Buffett used to say, be fearful when others are greedy and be greedy when others are fearful. So that is all up to you. So as per me, I am really bullish on HDFC Bank, and if I get it at even lower rate, and even at current rates, I am buying and I am averaging my position. And South Indian Bank, already I have a sizable position, and it is at an all-time high currently as I speak. I am still uh, very much positive on the bank and their capability of the management. So going forward, I expect the earnings to further increase, and again taking the stock price even higher. So that's all my view on these two banks. If you have your own views and any difference of opinion or any suggestions, you can uh, please comment me in the comment box so that I can review all those comments and reply to each and every comment of yours. Hope this session was useful for you. See you in next video. Till then, happy investing.